Two people, same city, same age, same starting salary. 20 years later, one of them is financially free. The other is still living paycheck to paycheck, still stressed, still wondering where the money goes. Same opportunities, same economy, same world. So what happened? It wasn't luck. It wasn't some secret investment. It wasn't an inheritance or a windfall. It was something far more fundamental. It was how they thought about money. Not what they did with it, at least not at first. It was how they thought about it, the beliefs they held, the way they saw every financial decision through a completely different lens. Because the thing nobody tells you about wealth is that before it ever shows up in your bank account, it has to first show up in your mind. Let's start with the most important mindset difference of all. It's so simple, it almost sounds obvious, but most people never actually live by it. Wealthy people think in terms of assets. Most people think in terms of expenses. Here's what that looks like. When the average person gets a raise, their first thought is usually about what they can now afford. A nicer apartment, a newer car, better restaurants. Their spending expands to match their new income. When a person with a wealthy mindset gets a raise, their first thought is about what they can now acquire. What asset can this extra money buy? How can this increase the amount of money working for them? One mindset sees money as something to spend. The other sees money as something to deploy. Robert Kiyosaki, author of one of the best-selling personal finance books ever, described this perfectly. An asset puts money into your pocket. A liability takes money out. A car is a liability. It costs you insurance, maintenance, and fuel every single month. An investment account is an asset. It generates returns that flow back to you. Even the house you live in is largely a liability in the short term, costing you mortgage interest, property taxes, and maintenance. But a rental property, managed correctly, is an asset. It generates income. This doesn't mean you can't own a car or a home. It means being honest about what each purchase actually is and making sure that over time you are deliberately accumulating more assets than liabilities. A study in the American Economic Review found the primary difference in wealth accumulation between high and low-income households wasn't the income gap itself, it was the asset accumulation gap. Income flows in and out. Assets build and compound. Here's the second shift, and it will reframe how you make decisions for the rest of your life. Wealthy people have a longer time horizon. That sounds simple, but the implications are profound. When most people make a financial decision, they're thinking about right now, this month, the immediate pleasure or pain. When wealthy people make a financial decision, they're thinking about 10 years from now, 20 years, sometimes even generationally. This changes everything. A market drop feels catastrophic if you're thinking about next month, but if you're thinking 20 years out, it feels like an opportunity. Buying an expensive item feels satisfying if you're thinking about today, but if you're thinking 10 years out, you're calculating what that money would be worth if it were invested instead. There's a famous psychological experiment called the Stanford Marshmallow Test. Young children were given a marshmallow and told that if they waited 15 minutes without eating it, they'd get 2. Some waited, some didn't. Decades later, follow-up research found that the kids who waited tended to have better outcomes in life, including financially. Now, that research has been debated, and we know that a child's environment and circumstances matter enormously, but the underlying principle holds. The ability to delay gratification is one of the most powerful financial skills you can develop. And unlike the kids in that test, this is a skill you can consciously build at any age. Every time you choose an investment over an impulse purchase, you're training that muscle. The wealthy didn't start with a longer time horizon. They developed one, decision by decision. Here's a third shift that separates the comfortable from the truly wealthy. Most of us are taught that the way to make more money is to work more hours, trade more time for more dollars. But there's a hard ceiling on that approach. You only have 24 hours in a day.
Wealthy people understand this, so they build systems that generate income that doesn't require their direct time, investments that pay dividends, businesses that operate without their constant presence, real estate that generates rental income.
This is often called passive income, but let's be honest, the internet has made that term almost meaningless. True passive income is not easy to build. It takes significant upfront work, or capital, or both. But the principle is real. The long-term goal is to gradually shift from a model where your income depends entirely on your time to a model where your money and your systems do the work. A study by the Federal Reserve found the wealthiest 10% of Americans derive a significantly larger portion of their income from investments and business ownership, not wages, compared to the bottom 90%. Every dollar you invest is a tiny employee working for you around the clock. The more of those you hire, the less you have to work. Fourth, wealthy people are almost obsessively specific about their goals. They don't just say, "I want to be rich." That's a wish. They say, "I want to have $800,000 invested by 55 so my portfolio generates enough passive income to cover my expenses without working." That's a goal. A famous Harvard business study found that the 3% of graduates who had written specific goals ended up earning 10 times as much as the other 97% combined. When you have a specific goal, your brain starts filtering the world differently. You notice relevant opportunities. You make decisions that align with it. Without a specific goal, every decision is made in a vacuum. Should I spend this or save it? Save it for what? By when? How much? Without answers, spending usually wins because it's immediate and tangible. Saving for a vague future feels abstract. Here's the fifth mindset shift, and it's a subtle one. Most people are afraid of financial risk, and that fear ends up being one of the most expensive things they ever experience. Because avoiding risk is not the same as being safe. Keeping your money in a savings account feels safe, but inflation is quietly eroding its value every year. The safe choice has a guaranteed negative real return. Not investing because the market might drop feels safe, but it means missing decades of compound growth. Wealthy people aren't reckless gamblers. Research by Dr. Sarah Stanley Fallow found that they are calculated risk takers. They understand the risks, they do their research, and they have a plan for the downside. The difference isn't that they are braver, it's that they've educated themselves enough to distinguish between perceived risk and actual risk. A stock market index fund feels risky to someone who doesn't understand it, but historically, over any 20-year period, it has never produced a negative return. The perceived risk is high, the actual long-term risk is remarkably low. Wealthy people see through the perception to the reality. And there are two other things wealthy people invest in that don't show up on any balance sheet: knowledge and relationships. A study by the National Bureau of Economic Research found a direct correlation between financial literacy and wealth. People who understood compound interest, diversification, and inflation accumulated significantly more wealth. Knowledge changes behavior, and behavior determines outcomes. As for relationships, the speaker, Jim Rohn, famously said, "You are the average of the 5 people you spend the most time with." Research supports this. A study in the journal Social Networks found that financial behaviors are significantly influenced by our social circles. If everyone around you spends everything they earn and treats debt as normal, that environment pulls you toward the same patterns. You don't have to abandon your friends, but you do need to be intentional about adding voices to your life through books, podcasts, mentors that expand your financial thinking. Finally, and this is deeply human, let's talk about failure. Most people treat a financial mistake, a bad investment, a business that didn't work, as proof that they're not cut out for this. They see it as a reason to stop trying. Wealthy people treat failure as data, not as their identity, as information. Before Howard Schultz built Starbucks, he was turned down by 217 banks when trying to raise money. 217 rejections. Most people would have stopped at 10. He kept going because each no gave him information about how to refine his pitch and his plan. Failure wasn't the end, it was part of the process.
Stanford psychologist Carol Dweck's work on growth mindset found that people who view their abilities as developable, not fixed, are dramatically more likely to persist through challenges and succeed. The person who believes, "I'm bad with money," makes one mistake and confirms their belief. The person who believes, "I'm learning to be better with money," makes the same mistake and extracts a lesson. Same mistake, completely different trajectory. So let's make this practical. You can start making these shifts today. Every time you make a purchase, ask, asset or liability? When you feel anxious about the market, ask, how does this look in 10 years? Write down one specific financial goal, a number and a date. Audit your financial environment. What voices are you listening to? And reframe your last financial mistake. It's not who you are, it's data on what to do differently next time. The gap between where you are and where you want to be isn't as wide as it feels. It's not separated by luck or some secret you don't have access to. It's separated by a way of thinking, a way of seeing money not as something that happens to you, but as something you direct, a tool for building the life you actually want. Wealthy people aren't a different species. They just think about money differently. And thinking, unlike your income, unlike your circumstances, is something you have the power to change, starting right now.